Good afternoon, everyone. We'll just wait a couple of minutes and just give everyone, maximum time, I guess, to join us. So if you don't mind just bearing with us for another minute or so, and we'll get started. Thank you very much. Okay, I think we'll get started. Good afternoon, everyone. My name's Clinton Reid, and on behalf of the Supervision Group, welcome in joining us this afternoon. If I may, look, we have a feature down the bottom there. It's chat. You may wish to just bring that screen up. If I may ask, if everyone can just answer in the text box there, yes, if you can hear me, okay. Fantastic. All right. Well, look, that's awesome. This chat box will also be an opportunity to ask us any questions as we go through this particular presentation. Welcome back to everyone that joined us last week for, I guess, the Stimulus 1 and Stimulus 2 presentation. We will be covering those particular measures again in this particular one, as well as the announcement made this afternoon. So if I may, I'd just like to thank our awesome team. It's been a race to the line here with the measures that were announced this afternoon between 1 and 1:30. So they've done an extraordinary job in being able to disseminate and collate that information, and we will be including that here this afternoon. So without any further ado, we've got a lot to cover. So we'll get straight into the presentation, and I think we're going to start with Melissa.
Thanks, Clinton. I'm here just to present. My name's Melissa. I'm one of the senior accountants here in the tax team, the business services team. I'm just going to cover a few things that have been covered before. We're just going to go over them again regarding the individuals. Chris, next slide, please.
Yep. I was just going to ask Pam if she can record the presentation, please.
Yeah, I sent you a message. All done. Already
Thank you.
recording.
Thank you.
As this hasn't changed from the stimulus package 1 and 2 for what's been released today, so we're just going to cover some old ground, but we just want to reiterate some of them. First thing is temporary access to early superannuation. So if you've lost your job or your income has reduced significantly, I think it's 20% is the ruling at the moment, you can access $10,000 from your superannuation, so there will be a balance that you can access of $10,000. It's tax-free, and it'll be for the 19-20 financial year. If need be, you can access an additional $10,000 from the 1st of July 2020 for the 2021 financial year. So $10,000 up to the 30th of June, and if you still need it, an additional $10,000 after the 1st of July. That will be tax-free. You don't need to include your tax return or declare it. You do need to apply through a MyGov account and link the ATO service to your MyGov account. That's really important because that's the way you need to basically apply for those details. So SMSFs will have separate arrangements, so you'll need to contact either Supervision if we do your SMSF or your accountant or to look at those arrangements because they will be slightly different. You won't, at this stage it doesn't look like you have to do it through your MyGov, but we're not 100% certain. And this will start from the middle of April 2020. So make sure you have your MyGov set up and your ATO account linked, and you can apply from mid-April. Next slide, please, Chris.
Oh, she's just got off the phone.
Okay, there's an increased what they call job seeker payment. So if you have lost your job due to COVID-19 and you're getting a job seeker payment, they're also extending it at a release last week to off study and youth allowance, you'll get your standard amount that you normally get, whatever that is based on your income tests and those sorts of things. You'll get an additional $550, so you could get it potentially up to $1,100 a fortnight. Don't forget to look at rent assistance and utilities assistance. Those are also part of it. There basically is no no assets test, and there's been a recent change to the income test released today. If your partner was earning up to $48,000, you weren't going to get anything. That has now increased to $79,692. So it gives you more room to be able to access that payment. Again, you need to look at getting a MyGov account and applying through either on the phone or in person if that's an option for you guys. One thing we'll be really clear about, don't commit any fraud. There will be penalties if you do that. So this is for those who genuinely need the payment. Can't just go down to the office and apply for the payment if you feel you want it, unfortunately. Well, fortunately, I guess. Chris, next slide, please. There's been some changes due to the deeming rate. So if you get a government pension or a payment and you have income earning assets outside of your super fund or in your personal name, the ATO and the government have certain rates at which they think that they're going to earn an income from those. Those, what they call deeming rates, have now been changed, and they will be changed from March 2020, so the month we're in now. And they will be reduced to a lower rate of 0.25% up to 2.25%. So it's essentially reducing, if you have dividends or interest income, they're expecting those rates to reduce, and they will allow that when they're calculating any government benefits you might be entitled to. Chris, next slide, please. For those who are on a pension from their super fund, SMSF, industry fund, there's a reduction in the minimum pension drawdown. So if, Chris, can you just go to the next slide, please? Okay. Based on your age and the balance that you have in your super fund, there's a minimum amount you need to draw down based on how much you have to draw down based on the balance of your age and the value of your account. Those rates have been halved, and they take effect from the 1920 year. So essentially, and they'll also relate to the 2021 year, so this financial year and next financial year. So if you've already drawn down your 4%, you cannot put the money back in and so reduce the pension you've taken out down to 2%. You have to keep the money out. Obviously, if you haven't drawn up to the if you've drawn more than the 2% but less than the 4%, obviously if you've met your minimum requirement based on the new rate, you're fine going forward. But you can't essentially put the money back in unless you're entitled to it, but please talk to your advisor, please talk to your accountant about those sorts of things. So look at those rates, look at your balance, look at your age, look at your account balance, and see what your minimum requirements are, because they've now changed for this year and next financial year.